Geographic trends. Bill Donahue from PwC is going to moderate. Bill, take it away.
Great, thanks, Trammell. So as Trammell said, my name is Bill Donahue. I'm a managing director at PwC. I have about 28 years experience working on exchange-traded funds. I am in the audit practice. I've helped a lot of issuers bring products to market. We're truly a global practice. We're the largest provider of ETF services in terms of AUM and number of funds in the globe. And let me introduce my panel as well, starting with Michael. Michael Venuto.
Does that mean I get to do it?
Yes, yes.
Okay. So I'm Mike Venuto. I'm the CIO and co-founder of Tidal Financial Group. We're an ETF platform that currently oversees about 10 billion in AUM and 122 ETFs. We touch, it's kind of funny, I was saying, I'm up here in a panel talking to 400 of my closest friends. I pretty much do business with every firm here. We recently announced a partnership with Han that we're cross-listing and working together. So most people think of us as a white label port platform. We do a lot more than that, and we'll probably get into some of that.
Perfect. Good morning, everybody. My name is Bernardo Guillamon. I work for the IDB, Inter-American Development Bank, based in Washington, on the largest regional development bank in the world, owned by 48 countries, headquartered in the US, and working on developing finance for many years in different positions, in charge of operations for the Indian countries, then also in integration trade, and my Office of Partnership, and my last job was the Chief of Staff of the President there. And now I'm very proud to be working with a firm here in New York, Syntax. Syntax has a wonderful opportunity to connect both worlds, the opportunities in emerging markets, using data analytics that they have unique capabilities in data analytics, and developing indexes, which I see as beautiful instruments and possibilities to open more investment into our developing market region. So we'll talk about a little bit about that. Thank you.
Kevin.
All right. Morning, everybody. Kevin Gopal, formerly, as of a couple of weeks ago, the head of ETFs for Bank of Montreal. I was there for 14 and a half years, started the ETF business. It's $100 billion in assets across about 150 listings. Number one asset gatherer in Canada for 13 years, 12 years in a row. And it's a great jurisdiction. Before that, I was at BGI for 6 years on the ETF side and the institutional side of the business.
Great.
Good morning, I'm Hector McNeil. I'm the token Englishman in the room, I think, but we'll have to see. Sorry? I think I'm loud enough, yeah. But so I'm the co-CEO and co-founder of Han ETF, stands for Hector and Nick. So we're the first and leading white label ETF platform in Europe, specializing in UCITS and ETNs and ETCs. Got just under 3 billion of assets. We've got ranges in thematics, spot crypto, which I know you guys are salivating for over here, but we've had them for a while, and also commodities. But we pretty much do any listing, any markets in Europe, and spreading out to LATAM as well. Thank you.
So our first question that I'll ask Kevin first. Can you describe what are some of the biggest challenges with respect to launching a new ETF, and where do you see in Canada some potential new opportunities for ETFs as well?
All right, thanks, Bill. I'll start with the second first, because in our industry we sell dreams, not challenges, right? So the opportunities in Canada. It's kind of funny when you speak about Canada outside of Canada, like you wonder why people care. And see the laughter tells me. But I'll give you a bit of an overview of Canada just quickly. So it's about $350 billion in assets in Canada, ETF assets, in Canadian listed ETFs. If I look at long-term assets, the non-cash assets, probably about $320 billion, which is smaller than SPY, your one ETF that you have here, but the whole industry. There's about 60 to 75 billion of US listed ETFs. US listed ETFs held by Canadian investors. And it's across about 1,100 listings. So it's relatively small, but the opportunities there are great for a couple of reasons. One, the regulatory environment is friendly. So Hector mentioned crypto. We've had crypto since 2021, physical crypto. the macro trends are great, increasing population, increasing wealth in the marketplace, sophisticated investor base. So it's a market that's growing quickly, and the ETF assets compared to the overall investable assets, investable fund assets, are probably about 13%, where I think in the US it's a lot higher. So the path from 13% to 25% of investable assets being ETFs is probably a straight line over the next couple of years. The earlier comments spoke about the challenges of mutual funds. In Canada, there's regulation that's coming out, total cost reporting in Canada for mutual funds, which is really going to hurt that industry and benefit ETFs. So there's a lot of opportunities there right now in ETFs. The biggest challenge there, I think, is education and the concentrated nature, perceived concentrated nature of distribution. Because there's 5 big banks in the country who have most of the advisor channels in Canada, and people believe, from the outside looking in, that it's hard to distribute within Canada. So there's a lot of new entrants trying to look at the marketplace, but they haven't figured out distribution properly. So it's one of the biggest challenges that are there. But there are a lot of opportunities for growth and innovation in Canada. Remember, a lot of you know that the first ETF in the world started in Canada. The first currency hedge, synthetic ETF, the first fixed income ETF, everything started in Canada. And as much as you can say it's easy to be first because you're first, a lot of you as issuers know that it takes a lot of work to become first. They work with the legal, tax, compliance, market makers, your operations teams to become first. So there's a lot of challenges, but with a friendly regulatory environment, you can try a lot of things in Canada. Actively manage ETFs. We're bigger in Canada for a long time because our rules were conducive to actively manage ETFs. So I think it's a great place to try things out and with a sophisticated investor base to grow.
Great. Thanks, Kevin. So, Hector, so a client comes to you, they have an idea. So let's, for example, I've been talking to a lot of U.S. asset managers who are looking to go to Europe. There's obviously different ways you can go. You could try to go organically. You could try to make an acquisition like ARC recently did acquiring Rise, or they could come to you. So let's say I'm a prospective client. Can you describe the process? I'm a U.S. asset manager looking to enter Europe. What's the vetting process you go through, and maybe what are some of the lessons learned that, as other folks who are looking to enter Europe might consider as well?
Yeah, I think the unique aspect of coming to Europe is a lot of people sort of conflate it with a direct comparison to the US. I mean, obviously it's a trading bloc, but it's 30 plus countries. It's 30 plus countries with different languages, cultures, currencies, exchanges, settlement systems, and different degrees of penetration in the markets. So often, I think one of the biggest issues that people coming to Europe have is they don't know what they don't know. So they have to go almost, we say probably if you do organic entry to the market, it's probably a 2 to 3 year journey to get to the start line. Anywhere up to $10 million and, hiring 10 guys and tying up all your key staff. And then there's probably another 3 to 5 years to figure out what you should have got right in the first place but got wrong. And that's pretty hard to model, when you're building out a financial model. And I think Kevin probably could give testimony to that because, BMO came to Europe and had some of their experiences. So I think that's a big decision from that perspective. And then you could go and buy someone. Crazily enough, there's less than 100 issuers in Europe. We did a tour with the LSE around the North America earlier this year, and the LSE is the biggest exchange with issuers. It's only got 53 issuers, so there isn't a lot of people to buy, and most of the businesses are either part of a big bank or a big asset manager. So those guys aren't going to let it go. So the premiums can be sort of 3 to 4 times the value of a normal asset management business. So you're paying a hell of a premium to get some staff who know what they're doing, and that's really what it's about. But there's probably only a handful of independent businesses. So then there's two ways left, which is one which is obviously the white label route, which has the advantage of speed and also reducing execution risk. I mean, we can have a fund out in 10 weeks as long as it's UCITS compliant. So that's pretty quick to get to market. And bear in mind, if you're doing it organically, it's 2 to 3 years to get to the start line, which at the end of that point in 3 years, iShares is twice as big as they were when you started out. So you lose a lot of time and a lot of ground in that sort of scenario. And the final version is incubate as well, right? Because you don't have to be wedded to a white label platform renting the infrastructure forever. You can use that to get into the market, learn what you're doing, and then when you're steady enough on your legs, you can bring it in house. And that's a pretty a big area that people are looking at. Certainly the bigger asset managers that we're working with now in order to look at that. You know, we've recently just done our first product with Societe Generale, and Societe Generale used to own a ETF business called Lixor, which was the second biggest in Europe, and sold it to Amundi. And they've decided to come back in the market using our platform, but I'm sure their intention is over time, once they've got to scale, to bring that back in-house. And I'd say that the biggest challenge probably for Europe, and we've talked a lot about distribution, and that's really it's really probably amplified tenfold in Europe, because it is so many different markets and so many different market penetrations. I mean, up until recently, retail was almost non-existent in Europe. And then Germany brought in ETF savings plans, and there's expectation there's going to be 32 million of those savings plans set up over the next couple of years. So there's been a bit of a retail revolution now in Europe, and that's spreading across the markets. So, and distribution's key, and that's why I think at hand we've spent so much time and energy that over half of the firm is involved in digital marketing and sales. So there's about 20 people in digital marketing sales that we do on behalf of our clients. So at one extreme, we can do the product only, and then the client looks after distribution, et cetera, or we can do the full shooting match or hybrid versions in between. The last thing I want to finish on as well is a lot of people always ask us to say, look, there's this great tax benefit in the US that drives people, you know, coming to the ETF market. Is there anything like that in Europe? And there actually is. Irish UCITS ETFs have a favorable tax treatment compared to any other structure in Europe. It only pays 15% withholding tax on US equities. And if you use any other structure, including Irish UCITS, so not the ETF version, but UCITS, you'll pay 30%. So if you go to Luxembourg, you'll pay 30%, or if you use mutual fund structures. So actually, that's really actually turning on a lot of active managers in Europe to sort of look at, well, I've got this mutual fund I'm giving up about 40, 50 basis points of alpha by just paying tax to the US government. And if I switch to a US UCITS ETF structure out of Ireland, I'm going to save half of that. So that's been a real big driver from that perspective.
Thanks, Hector. So, Michael, as was mentioned earlier, the announcement that MFS is planning to launch ETFs sometime in 2024. So then there'll be one remaining top 20 U.S. asset manager who doesn't have ETFs. PwC had a report about 10 years ago saying everyone should have an ETF strategy. Not having ETFs is a strategy, not a very good one. Can you describe, as you're talking to prospective potential ETF issuers, what are some of the challenges or issues, and maybe how quickly can they come to you and get to the point where they can launch?
Okay. It's amazing to me that there's even one left. And then you go further down, there's a ton more. And well, let's start with the shortest question, right? So through a platform like ours, we can get you to market in 100 days. Like, it's that simple, right? I think the thing that most of these bigger firms get stuck up on is the product, right? When it comes to US ETFs, the product matters more than everything else. In Europe, sales and distribution matter more than the product, right? Because you got to sell it. In the US, especially for new issuers, getting the product right is the number one thing. And getting the product right is not just, oh, I've got a Sharpe ratio. Nobody in this room should ever come to me and pitch that they've got the ETF idea with the best Sharpe ratio, right? Like, I get that pitch twice a week. Nobody is ever buying your ETF on your Sharpe ratio. The right product is, the narrative is right for this time. You have seed. You've put the right expense ratio on it. You've actually done an assessment and gone through it. That's one of the things that we do with each one of these is, when somebody comes to us with a good idea, some of you in this audience have done it with us, we do an assessment. It's 114 questions. We've asked 300 or 400 prospective issuers these 114 questions, and then we score it. And we say, this is likely to exceed, this isn't, here's the recommendation, here's a detailed pro forma. And then with the bigger groups, that goes into the black hole of bureaucracy for 6 months, and then eventually comes out and we launch their fund. So I can do it in 100 days. The bigger institutions probably take 6 to 9 months.
Yeah, and I would say that's the same case too when we've been working with a lot of issuers who are looking to convert mutual funds to ETFs. a number of the early ones, and even lately, it takes 6 to 9 months to convert a mutual fund to an ETF, and working through all of the various partnerships, brokerage arrangements, regulatory filings, and the like. So as much as perhaps people think, okay, that's a great way to enter, and we've seen some people enter that way, it's also very expensive and very disruptive, and it's certainly not something I would recommend that people try to do it at night and weekends. It's just not going to work. So Bernardo, you come to this panel with unique perspective, obviously, with your background and experience in various Latin American countries. Can you describe to us what the opportunities are for ETFs in Latin America, and are there particular countries that come to mind that maybe create or have greater opportunities than others?
Perfect. Thank you very much. I want to mention particularly the opportunity of Latin America, reflecting on, after seeing in my career 30 years the developments of the region. Now we're seeing, particularly the geopolitics of the world, a moment that Latin America has shown several of the key countries good macroeconomic management. You can see example of Mexico, of Brazil, Chile, Peru, that you have democracies occurring there that are working in a smooth way. And we see also all this reflected also in a boost in foreign direct investment into the region. This past year was a record level of $220 billion, and it's projected in 4 years to surpass Asia as a whole, the foreign direct investment. And this is happening because there are several things occurring that are making these conditions a good opportunity for investors to come. I want to highlight particularly in some key facts. One is the reconfiguration of global value chains. Several investors are starting to, companies are moving their operations towards Mexico and the Central American region, getting nearshoring closer to their operations here. This is bringing a lot of investments towards the region. Also, we see a boost in investments in renewable energy. This is a region that has a very rich energy matrix. In traditional energy, you have situations like Guyana, which is growing at 60% a year in the last few years with all the oil business, and countries that are very powerful in oil. But we see now a big expansion in renewables. You see Brazil becoming number 4 in the world in renewables investments. You see countries like Costa Rica and Uruguay that are almost 100% renewable in the electricity matrix. So Latin America is a very good ground for renewables, for energy in the region, for energy investors, but also in agriculture. Latin America is becoming a powerhouse in agriculture. It's also a big provider of the main commodities in the world. 50% of soybeans already come from the region. They also is becoming a top producer in beef. The big players in the protein business, companies are from Latin America, from Brazil. And also in critical minerals, not only traditional minerals, but also critical minerals. And you see all this coming as an opportunity in the region. Countries like Brazil, like Mexico, like Chile and the Indian countries have these opportunities. But it's not only a story of commodities and traditional business groups. We see a lot of innovation happening in the last 10 years, particularly in the digital transformation in the region. We have the region with a very high penetrated younger population, 660 million people, twice the US population, down south, 6 trillion economy, with almost 70% penetration of mobile, and also a boom we're seeing a boom in venture capital financing and new IPOs coming to the market in topics like new bank, a fully online bank that has already 85 million customers all over the region in a period of few years. You see Mercado Libre, which is a player in the e-commerce business, which is also a very dynamic player that already 3-4 years ago employed only 10,000 people. Now it's 50,000 people. I just moved to Latin America, and you do everything through Mercado Libre. And in logistics, in other things. So you see huge disruptions in the technology area. So I see a lot of opportunity. We can discuss more in detail some of those. but among these opportunities with a more stable climate, with the geopolitics that make benefit Latin America towards the future and a better connection with the U.S. market.
Great, thank you. So you can't go a day without seeing an article, particularly in the U.S., with respect to proposed spot Bitcoin ETFs. And at last count, there's 10, 12 different filings that, depending upon the day and time, some people are theorizing they might get approved sometime by the end of this year, with possible launches in the first quarter of 2024. We have two panelists, Hector and Kevin, who have experience in the European and Canadian markets, who've already have had for a number of years spot Bitcoin ETFs. Can you kind of describe, first, Kevin, in Canada, how did the products work initially? How are they working now, and is there further growth opportunities in that space as well?
Sure. So the Bank of Montreal didn't have any crypto-focused ETFs, but there was an approval to do so, because we do believe in the thesis. So they did believe in the thesis, all the way from the top, the CEO of the bank, all the way down. There was support there. But as much as the first physical ETF was launched in Canada in 2021, it took 2 years of education with the regulators to get them to that spot, to the point. And but they were open to the discussion. They said, if this is truly the future, or there's some people believe it is the future, how can you prove to me that it's not going to lead to a very bad client experience? And that took a long time, but they were very receptive and they're responsive over those 2 years. Where they landed is, we'll approve the crypto assets that have futures tied to them. So in their mind, they trusted there's some sort of liquidity vehicle around it if something happened to the physical Bitcoin. So that was their one requirement. So that's why right now there's a Bitcoin and Ether. But so far, aside from the volatility in the asset class, which is to be expected, they were fine with it. And there's a couple of tests they said, like, you have to be able to prove that you can communicate to people that this is going to be more volatile than almost any asset class that they have right now. There has to be some way to more disseminate information clearly, like on how to educate people on what they're buying, what it means to them, how to educate in the portfolios. And I think those issuers like Purpose Investments, CI Financial, Evolve, they've done a really good job, and Fidelity's in the game now too. They've done a really good job educating the clients, and the assets, from a Canadian perspective, they're probably about $3 billion right now in assets, and I do see that the price return recently. I think that's going to start growing too. So it's been a generally overall good experience and open to more innovation.
Great. And Hector, for Europe?
Yeah, so Europe's had spot crypto products since about 2019. Funnily enough, we have a range of about 8 spot products. So we've got, in fact, our largest product on the platform just in the last week has become Bitcoin. So we have just under $1 billion of spot Bitcoin. But we also have spot Ethereum, Cardano, Solana, Litecoin, Bitcoin Cash, and various other products as well. And really what it does for me here is, I just believe that, our jobs as ETF issuers are to create, very robust, trading and investment vehicles that basically protect clients, give them liquidity, and give them market access. That's where ETFs are actually at their strongest and most powerful. And I really have a big problem with the regulators. We have the same issue with the FCA in the UK. Funny enough, we have a government that's very pro crypto, but we have a regulator who's very anti-crypto. But I think that will change. But for me, it seems insane that my mother can go and get an email, from some Bitcoin get-rich-quick scheme and go and trade on a Turkish so-called exchange, and lose all her money. But she can't trade a regulated product on a regulated exchange, only available through a regulated broker who has to do a suitability test before they give access to that product. That's the insanity of it for me. The cat is out the bag with crypto. It's gone. People will want to invest in it. The technology is very liberating for investors. So our duty as an industry and the regulators need to get our act together and basically provide a product that fulfills all those tick box advantages which I just mentioned before. So as I say, we've got 8. You could have up to 20 different products in Europe. One of the major features we have, which I think is very, very good for investors, is they can take physical delivery directly with the vehicle. So they can put in an application. We do the same with our gold ETF as well. we can exchange that for gold coins and bars, and in the same way, people can exchange directly for their Bitcoins as well. And one of the most important features is we don't issue any of the units until the crypto is in cold storage. So essentially, the market maker takes risk against the vehicle until it is actually in the vault, and that's really, really important, I think, from an investor protection perspective.
And Bill, the one thing I just add quickly is like the one part that kind of stifles innovation was the AP side of the business. So very few of the APs could actually trade. Well, none of them can actually really trade. Except for one, but can actually trade physical Bitcoin, and so they or Ether. But so they're doing futures, which I mean, there's some hedging issues with that as well. So their compliance offices were saying you guys can't make markets on this, and there's not a lot of U.S. players up there. So as much as the regulators approve them, the businesses were not approving them. So I think there's more opportunities for growth.
I think that's true, but I also think what's quite exciting about the space is that new APs have come into the game. Yeah. People like XTX, who weren't involved in ETFs before. So there are people who are, coming into the marketplace. And, my biggest fear in the ETF market is the lack of liquidity providers. So actually, if we bring asset classes that bring new liquidity providers into space, I think that's a massive added value to the business.
So, Michael, lately I've gotten a number of phone calls from European asset managers looking to come to the U.S. What's a typical conversation you'll have with a European asset manager? Maybe it's going to change now that you're partnering with Hector, but what are you view as some of the challenges or opportunities a European asset manager may face as they look to enter the U.S. market?
I thought I was going to get to talk crypto, but yeah. So first thing is it's regulatory, right? So we have major institutions that we've worked with Hector or independently that are looking to come to the U.S., and when they're coming here, they've got to decide, am I going to become an asset manager here, an advisor, or am I just going to put it under my brand and all that? And then that's all stuff that can get worked out, right? These are all things that can be done by hiring a fiduciary, right? We can step in or we can step in and hire another sub-advisor, this or that. So that's not really the big hurdle. I think the biggest hurdle is product again. I hate to go back to what I said earlier, but it really is true, right? I just heard the whole crypto thing. It's funny, Latin America had it first, then Europe, then Canada.
I think we were first.
Yeah, but you weren't really an ETF yet, right? The real, yeah. I'm not going to debate with you up here. And U.S. is still behind, right? So like, it's product at the right time. And I see a lot of times what's working in one region does not just translate here. So the dreaded term ESG, right? It's done really, really well in Europe and in other geographies. Here it's like everybody's running from it now and they want to call it impact or sustainability or we're exclusionary or this or that. So the idea that, I've been doing it this way for 100 years in Europe and I'm going to just translate that to the US, that's not that simple. And getting people to understand that, it's the same going the other way, right? Like just because it worked here doesn't work there. Sometimes it's a tax issue. Sometimes, I think about what's worked for us this year. Our Yield Max suite, I've got one of our Yield Max people here today. It's gone through the roof because people want yield. Hector and I have been talking about how to bring it there. It's hard, right? Because there's a different tax structure. Sylvia was up here 10 minutes ago. Zero DTE call options to generate 60% yields off the Qs. Yeah, that sells in the US. I don't know that it's going to sell in Europe. We're going to figure it out. It's all that structuring things, getting the right thing here at the right time. That's the biggest thing for success in the ETF market. Number two is going to be staying alive, right? We onboarded Cambria this year. I always use Meb's quote that the best thing an asset manager can do to succeed is survive, because eventually the cycle comes to you. And I see way too many people come to this industry with like a 2-year runway and the belief that Kevin Costner is going to save them, that it's a field of dreams, right? Like, if I build it, they will come. No, they're not coming if you don't have the right product at the right time with the right runway and you put the sales and marketing dollars behind it. We've had like Bob Elliott as an example on our trust. Everybody's heard of this guy now. He was like unknown. He was one of the investment folks at Bridgewater. He's trying to democratize that kind of thing in the ETF space. Overnight success. I don't know anyone who works harder than Bob Elliott. This guy talks to 20 RIAs a day. Most new issuers come in, 10 minutes, okay. And they talk to the market makers 3 times a day and their friends 2 times a day. If you're not talking to 20 RIAs a day, you're not doing your job as a new issuer. You don't need to call Hempstead. He's got your markets. You don't need to call Reggie, Jenica. They know you need to call RIAs. And that's the hard truth in coming to America. You got to do the work.
I think it's worth just topping and tailing that though, Mike, is that I think our relationship now, the JV that we've got, is that if people believe they've got really strong IP and it's new, they can simultaneously list that in the US and in Europe. And pretty much with the UCITS and 40 Act, you pretty much cover the globe from that perspective. So I do think that's, because people, you know, when people, there's not, you've seen it time and time again where people will have a great success in one of the markets and people will steal that idea and even they steal the ticker, you know, the whole thing and jump on that. Under this arrangement, you'll be able to protect that from day one by doing this at the same time. And I think that's really quite powerful, actually.
Absolutely. And it's funny because you never know, right? So like I always go back to Wisdom Tree when they launched the Put Right Fund. Got no assets here, got like 200 million in Europe right away. Like, so it's sometimes you have to take the bet on both markets to see which one is ready for it.
Okay, this is a quick one to each of you, so I'll give each of you like 30 seconds. What is one regulatory business or market development that you look at 12 months from now, you believe in your respective markets will have the biggest impact? I'll start with Bernardo.
I think the changes in regulatory and incentive for investments in renewable energy happening in the region, particularly Brazil, that are coming now, will be a huge driver of investments into the sector. And same thing might happen in other parts of the region too.
All right. Kevin?
With Canada, you know, we never had dedicated ETF rules. They were just like under this 81-102 regulatory regime that covers mutual funds. So an ETF is considered a mutual fund trust that's just on an exchange. So the regulators are now thinking, should we have rules for ETFs? And you just never know where that goes. Like as part of the body, the Canadian ETF Association, we're trying to make sure we help shape that properly, but that could add some risk to our business.
Hector?
Yeah, I mean, Europe essentially is 3 to 4 years behind the US, and I think next year it's going to be the year of defined outcome and active. I think it's going to be massive in Europe, and Europe's actually a much bigger active market than the US. I actually think Kathy coming to Europe has been a big shake of the cage for active managers. So I think active and defined outcome are going to be big things in Europe next year.
And Michael?
All right, so in the US, everybody always points to 6011. Sylvia covered on the last panel. The thing that I've seen that's changed the ETF industry the most and what I expect to continue to have the biggest impact is actually the derivatives rule. It's called 18F4 for all of you that want to read something to help you sleep. But it's changed the ability to bring complex product to the market, right? It's no longer just Delta One. I can do covered calls. I can do synthetics. I can do all kinds of things in an ETF wrapper that couldn't have been done 2 years ago. And it's very complicated. It requires a derivative risk program. It requires VAR testing. It's something that on the title platform we've decided to very much focus on because we see that as tons of white space where people can get in and actually change things. And it's also where we've seen the most success this year with the Defiance products and the Yield Max products and other things that we've done with like Jerry Parker, right? One of the original turtles. We've able to literally take essentially his hedge fund and bring it to market as an ETF, while multiple other issuers told him it was impossible. We did it, and I'm really proud of those kinds of things. So complex products through 18F4, I don't think that slows down.
Okay, great. So we have 5 minutes left, so we're going to open it up to audience questions.
Not all at once.
All right, in the back there.
Question for Hector. Talk a little bit about the difference between cross-listing products listed here in Europe or other countries versus listing them in parallel.
So the questions around like cross-listing products in other countries.
Since MiFID II, you can't actually buy US ETFs in Europe. So essentially, you have to have the same sort of IP and payout structure in UCITS or ETNs. 2/5 of all products in Europe actually are ETNs now. And usually ETNs are used where UCITS doesn't allow the structure, say like single commodities or digital assets, etc., which I think was what Mike was alluding to. Cross listings are really, I'm probably one of the only fans of cross listings in Europe. Most people don't like it because it splits liquidity. But I actually think it gives you a shop window into all of those markets which do have complex cultures and languages, etc. So as a minimum, we tend to list as a core service into Italy, Germany, and the UK, and then we passport for sale in all the other countries. We also, as a secondary, will list in France, Switzerland, Mexico, and Poland as secondary choices, but that's mainly driven by demand. So essentially what you're doing is you're taking the same product and having multiple listings across Europe. And it gives you a couple of advantages. It gives you sort of like, it forces you to go and hire local salespeople, distribution, which we have in all those markets, all your marketing materials, the products are tax benign, all those great things. And also, it gives you a shop window into the market. So I'm a big believer in the PR side of distribution. And an Italian journalist will not cover a product unless it's listed on the Borsa Italiana. So that's where the cross listings are really, really important. It gives you that sort of footprint. It gives you almost a home bias for all of those markets, which is really key.
Great. Do we have any other questions? Yes, in the front here.
Hey. So you guys spoke a lot about different regions and specifically Europe and the US. Do you think there's a competitive advantage for European issuers going to the US and US in Europe, and specifically around distribution?
I mean, I'll chime in first, right? Like, if you have great IP, a great product, you want to sell it in as many places as you can, right? And with the way the regulations are set up, it's much better to have a product in Europe and a product in the US and a product in Canada. And ironically, in Latin America, a lot of times it's better to have the European product because it's better taxes to cross-list, essentially. So a lot of times, like in the US, if a client comes to us and wants to sell into Mexico, it's got to be a passive product. So a lot of times you get these very active indexes that are being packaged up so that they can sell into Mexico. But yeah, the advantage is more people to sell to. And it's, an idea that has $1 billion in the US is probably going to have 200 million in Canada and 400 or 500 million in Europe and 100 in Latin America, right? I mean, ballparks.
Yeah, I think that's exactly right. What I would say, though, is to some extent, my view is there's probably more opportunity in Europe because there's less competition. It's a much more competitive market here, and bear in mind that Europe's double the population of the US and a similar wealth demographic. So, I always find it very hard to do the timing on that, whether it's 3, 5, 10 years, whatever. But Europe is always catching up to the point when we came up with the idea, Han, 5 years ago. The assets in the US are the same as where the assets are today in Europe. So that's almost like a direct measurement of that sort of gap. So I think there's, to some extent, there's way more opportunity there, but it's the runway, which Mike talks about, which is always the unknown. But there's much less crowded space. I think there's less than 10% of the asset management industry in Europe that have the ETF wrapper, where I think you're much more up towards a 50%, 60%. So, but I believe if you're a mid to large size asset manager, you've got to be in both markets for Latin America, Asia, whatever it is. I mean, the great beauty of the UCITS now is because they're settled through Euroclear and Clearstream, you can pretty much cross-list them anywhere in the world except here.
Yeah, I would tend to agree with respect to Europe, and I think the sooner they get their arms around the fact that portfolio transparency, we see it in the US, people want to see active, fully transparent ETFs. As soon as Europeans, asset managers realize that, you're going to see a groundswell of new product, and it's going to really take off in Europe.
That's where I think ARC coming to Europe is going to shake the tree on that.
Well, I can tell you, we're working with our clients, there's a lot of, I guess, activity going a little bit below the surface there that I don't think it's just ARC. There's a lot of very large traditional asset managers who've been on the sidelines in Europe that are coming in the next 12 to 18 months.
Yeah, I would agree with that. I'd say that, we've had 1,500 inquiries at Han since we launched, so almost 1.5 a day for white labeling, and it used to be around about 2 to 3% would be active, but over the last year it's been 30%. We actually have 5 active funds in filing currently, so that's definitely going to be the big growth area for next year and beyond.
Yeah, we did 50 funds this year, and only 2 were passive.
So I think that takes up our time. So if you could thank our panelists, appreciate it.